this industry is poised to grow, right? So, but what the industry doesn't like is uncertainty. And of course, after a very strong Q1 was very strong in deal making. April was so-so, as you know, because of the uncertainty that was introduced via policy issues, tariffs, and so on. But the market fundamentals are absolutely intact. Plenty of capital out there, 1.2 trillion of dry powder, uninvested capital, plenty of companies worth owning. So we believe as soon as the uncertainty eases, deals will happen and they will come back relatively quickly. Now, 30,000 companies out there in the portfolios you mentioned. That's right. So there is a bit of an exit jam. The industry has not been able to do enough exits, and this needs to come back. They need to create liquidity. We are in a liquidity crisis in this industry because there haven't been enough exits, not enough returns to LPs. All of this needs to be solved in the years to come.
How do you solve that? I mean, there's a lot of debate here at the conference about whether we've seen peak PE. The world of interest rates near zero is over, and it doesn't look like it's coming back anytime soon. So what is the outlook generally for the industry?
Yeah, the outlook is good. Assets under management are increasing. It's a very strong asset class. When you ask LPs, they want to increase their allocation into this asset class, especially in infrastructure and private credit, but also in general buyout. It's just the exits need to happen. And as there are many ways to do exits, the classical full sale, but today you can also do partial sales, continuation vehicles, secondaries, dividend recaps. So the industry is becoming creative and is very resilient how to create exits.
It's interesting to say LPs still want to allocate more capital to the sector when LPs are increasingly having to turn to secondary markets to try to access cash, given how weak exits have been. But LPs still want to get involved in the sector? LPs
want to get involved in the sector. Midterm, they want to allocate more to the sector, but short term, they need to solve the liquidity crisis. Liquidity crisis is also bad for the GPs, right? The holding periods in the portfolio have gone quite long. Last year, only 11% of net asset value was returned to LPs. This translates into almost 10 years holding period, right? So that's not what they signed up for, right? The GPs. So you have longer holding periods. You're spread thin with your team over a big portfolio. You need to solve this. But it also creates value creation opportunities. You're holding companies longer. You can create more value. You can actually get earnings up and can work on them.
The other side of the argument is that the PE industry boomed in 2021 in a world of low interest rates, and now there's a lot of speculation as to whether they overpaid for a lot of these assets, and that's part of why it's been difficult to exit. And what's your response to that?
The industry is very good at pricing risk, right? But market fundamentals obviously change with interest rates, with macro environment, and so on. Now, what I've seen, I'm in this industry for 25 years, right? So this industry has survived the pandemic. It has survived various interest rate hikes. It has survived inflation increases, so it will survive this too. I think the current policy, let's say, difficulties are another bump in the road, but not more. I think the industry is poised to grow. And I'm sure that once the uncertainty eases, we'll see plenty of more deals and plenty of more exits. Actually, the pipelines for our clients are full. I talk to our clients every day. Their pipelines are filling up. They're getting filled. They're getting ready for the months and years to come.
So do you think 2025 is a foregone conclusion that we are going to continue to see the capital markets effectively close? Or is there still a chance, given the strong pipeline you just described, that we actually see deal making pick up again?
Yeah, I think there is quite a chance. It's not a foregone conclusion. Q1 was very strong. April was very weak. Let's see where Q2 comes out. But it's not a foregone conclusion that 25 will be weak. Now, when I talk to our clients, they don't invest so much time in forecasting H2, right? They're getting prepared and having the right playbooks. In such a market, you need to know what deals to underwrite, how to price risk, how to create value in your portfolio, what types of deal you want to do. So playbook beats forecast in this market.
You note in your most recent report that fundraising for private equity has never been harder.
Right. Yes.
This comes at a time when we're seeing funds increasingly think about trying to lure in retail investors, trying to bring in wealth clients.
Yes.
Does it make sense to be bringing in these investors into what is a pretty opaque and illiquid market?
Well, fundraising with institutional investors is very tough, as you just cited from our private equity mid-year report. For every dollar of supply of fundraising out there are $3 of demand, so 3 to 1. 2,400 funds are on the road out there competing for capital. It's very tough. There are very tough conversations between GPs and LPs happening. So therefore it's natural to pivot to the private wealth sector. Private wealth sector has also changed. You know, most private wealth managers advise their clients to have actually a private equity allocation today. That's different from a few years ago.
Right.
So private wealth is a very important source of capital for the industry. In fact, most of the GPs are building up or have built up relatively significant private wealth teams. Now, of course, all the regulation needs to be in place. Investors need to be educated. Mostly these are high net worth individuals, of course, which are educated about the asset class, which we think is very, very important.